salary sacrifice, we've had a range of questions from you in relation to salary sacrifice. Hopefully this next part of the session, and transition to retirement, hopefully this next part of the session will address all your questions there. Now, how does salary sacrifice work? Well, normally when your employer pays you, they firstly deduct some tax, so pay-as-you-go tax from your income, and then they, depending on how much you earn, it's a different rate. So it might be 21, 34.5, 39, or if you're in the top marginal bracket earning over $180,000 this financial year, you're paying 49% tax over that threshold. So your employer deducts that withholding tax from you, and then with the remaining amount, they generally put that into your bank account. Now you can go and spend that money, you can save that money, and you could put some money into your superannuation as well. You might do that to get access to the government co-contribution, for example, which is put $1,000 into your fund and the government gives you $500 if you're earning less than about $33,000 per annum. Now the alternative is, if you are salary sacrificing, what your employer does is before paying any tax, they're directing money directly from them to your superannuation account. Now the key thing here is that happens before any withholding tax is being paid. So the amount of withholding tax that we talked about up here is reduced, and that's the key benefit. So you do pay some contributions tax. So if you look at when you do put money into super as a salary sacrifice contribution, there are contributions tax payable here. But the key thing about salary sacrifice is that the contributions tax is less than, so it's generally 15%, or if you have an income over $300,000, the contributions tax is 30%. Now the key benefit here is that you'll pay less pay-as-you-go tax because you're reducing your income by putting money into super, and you're paying less pay-as-you-go tax. The remaining amount that your employer has left over, it will go into your bank account, so you'll be getting less into your bank account, but overall, because you're paying less tax, you're often better off. The money that goes into your bank account, you can still spend that, you can still save it, but the key thing to remember about salary sacrificing to superannuation is the benefit is the difference between your marginal tax rate, whether that be 21%, 34.5%, 39 and 4 or 49, is the difference between your pay-as-you-go marginal tax rate and the contributions tax rate, depending on what your earnings are. If we leave off those earning over $300,000, then the benefit here is the difference between 15% and 21%. So you've got a benefit there of what, 6%? So if you were salary sacrificing $10,000, 6% of that is going to be what, $600, is it? If you're on the 34% tax bracket, so you're earning between $37,000 and $80,000, then the difference here on $10,000 is going to be 19.5%, or on a $10,000 being salary sacrificed, $19,500. If you're earning over $80,000, then the benefit or the difference between the contributions tax rate of 15% and your marginal tax rate is going to be 24%. So on $10,000 salary sacrifice, you're going to save $2,400 per annum. Now, so depending on your tax rate, you're going to have potential savings, on $10,000 of $2,400 to $600, or between those thresholds. If you're on 49% tax bracket, earning over $180,000, then the amount that you salary sacrifice, 15%, so at 34%, or $3,400. Hopefully I'm doing my sums on the fly. I'm terrible when I do them on the fly. Assuming that you're earning less than that $300,000 mark. So you can see this is the tax saving on salary sacrificing into super rather than taking your income in your hand. So the benefit of salary sacrifice, we've just talked about the benefit and we've done the calculations there, but if you want to do your own calculations on your particular scenario, then you can use this formula here. So the benefit is your marginal tax rate plus the Medicare levy, which is now 2%, gone up from 1.5% because of the National Disability Scheme. So it's the marginal tax rate plus the Medicare levy less the contributions tax rate of 15% times the salary sacrifice amount is that benefit. So look at Ben, he's on $67,000 per annum. His salary sacrifice is $28,000. His net benefit is $5,616 per annum. That's just an incredible. It even might be greater than that because of the low income tax offset as well. So it might be getting close to $6,000 in annual tax savings by salary sacrificing. So you can see the benefit of this particular strategy when you're trying to build up your retirement savings. $6,000 a year as you're moving towards retirement is significant. When should you salary sacrifice? It's not always going to be right for you, and it's not right for everybody, but you need to consider, if you are in debt, whether that be consumer debt or mortgage debt, whether you should focus on debt first. So you need to just consider that first. You've got to look at your tax rate, but generally if you're earning over $20,500, you're paying more than 15% tax, and therefore salary sacrifice does provide some benefit. You need to look at your contribution limit, so don't go over the $30,000 contribution limit. Your employment income needs to be less than $274,000. You need to look at your cash flow. Can you actually do without the cash flow? Transition to retirement can actually help, that strategy can actually help with your cash flow, but you just need to be making sure that you're not ploughing all this money into super, but you also need to live, so you've got to have enough money to live on as well. And you also need to think about access to your super. If you're 10 or 20 years away from being eligible to touch your super, then you might not be as aggressive as somebody who is 2 to 5 years away from being able to access their superannuation money. So you need to factor in all those things there. So how much should I salary sacrifice? This is an important point, that the mature age worker tax offset has been cancelled this year. There also was announced in the budget they were going to get rid of the senior Australians and pensioners tax offset, but they haven't got that through the Parliament as yet. So for those people who there used to be a difference in your tax-free threshold because of these mature age worker tax offset. If you were under 55, you could earn up to $20,500 to pay no tax, and if you're over 50, you could earn up to $23,000 and pay no tax. Now that the mature age workers tax offset has been eliminated, then there's only it doesn't matter if you're over 55 or under 55, it's still the $20,500 effective tax-free threshold. That's because of the low income tax offset that can apply at that rate. So let's make an assumption that we've got $44,000 earnings or employment income per year, and you're 55 years of old, which is superfluous now, because it doesn't matter if you're older or younger because of elimination of the mature age workers tax offset. Now, so $44,000 per annum, how much should your salary sacrifice? Well, you could bring it down to, and I think we've just left it at the $23,000 figure. If your salary sacrifice $21,000 into your super fund, then the tax saving there is that $2,312. That's the annual benefit you could attain if you had an income of $44,000 per annum. You need to make sure that you don't exceed your concessional contribution limits, and this is a key one. If you are looking at starting a salary sacrifice strategy, then just appreciate this part of it. You can't exceed your contribution limit. You can, but there are some penalties with it. They've reduced the penalties actually, so it's not as bad as it was in the past, but there still are some penalties for doing so. So you don't want to exceed your contribution limit. It's $35,000 this financial year for those who are 50 or over, and $30,000 for those that are under 50. Now let's have a look at how this works. If you're on an income of $115,000, you might say that, well, I've got a $35,000 threshold, the concessional contribution limit, and therefore I can salary sacrifice $35,000 into my super fund. But you would be, if you're an employee, you would be then breaching your contribution limit, because the $35,000 includes your 9.5% employer contributions. So you've got to deduct that 9.5% of $115,000 salary before you work out how much you can salary sacrifice. So let's do that again, do the calculation. So 9.5% of $115,000 less $35,000 gives you $24,075 that you can salary sacrifice during the financial year without breaching your contribution limit. So if you put $24,075 across into our super as a salary sacrifice, then our tax saving here is going to be just under $6,000 per annum, which is significant. But hopefully you appreciate the difference there, that we're factoring in the superannuation guarantee contributions that your employer puts in for you. The other thing is about cash flow, so making sure that you meet your cash flow requirements, and looking at a $100,000 income. We're still on a $115,000 income, but we need $100,000 to live on. Then we can salary sacrifice $24,000 into the super fund, but we might then realise that there's an income gap. We're not going to meet our cash flow requirements. Now, we could reduce the amount that we salary sacrifice. We could actually reduce that down to $15,000, so that we're meeting our income requirement here of $100,000. But we're going to miss out on $2,000 or more than $2,000 in tax savings if we do that. So what's the alternative? This is where the transition to retirement strategy comes in. We can still salary sacrifice the maximum amount, get those tax savings of just under $6,000, but to meet our income requirement, if we've reached our preservation age, we could meet that income requirement by drawing some money from our superannuation, which is effectively the transition to retirement strategy.